Hi, this is Dan Kurz, DK Analytics. Thanks a lot for tuning in. It is Monday, July 29th, 2019. Good evening from Switzerland once again. The topic of my video is the U.S. abandons any fiscal rectitude. Big government rules the roost, underpinned by the Fed. Let me get to some valuation metrics before diving into this topic. The trade-weighted U.S. dollar stood at 91.48 recently, which is at still a very high level following a multi-year progression higher relative to the other leading fiat currencies on the back of expectations that the U.S.'s financial repression would actually work. That is, we'd have stronger growth and higher interest rates. That reality hasn't quite dawned yet on a lot of investors, and when it will, and the U.S. joins the rest of the world in zero interest rates and the return to QE, I think the dollar is going for a ride down. This realization, that is at least the weak growth part of it, has already been discounted in the 10-year Treasury, which has gone up in value quite substantially as the yield has come down quite substantially recently to 2.06%. And that bond, in essence, reflecting increasing economic weakness. I'd argue we've never gotten out of the recession, but that's neither here nor there for this. But let's say that the 10-year bond has gone up and yields have come down because of expected economic weakness, while at the same time, bondholders have not yet dialed in the rising monetary inflation and solvency concerns. At the other end of the asset spectrum, stocks, the S&P 500 has just been going from strength to strength, one new high after the other, week after week, sometimes day after day, and it seems to be punch drunk on the expectation of substantial Fed ease around the corner, with which we agree, but at the same time, the stock market is looking into the earnings abyss that is also, if not around the corner, not too far down the road. Oil, meanwhile, at $56 a barrel, WTI recently, is hanging in there between the 50s, $5 and $60 range. It's buffeted on the one hand by decreasing demand, given a slowing global economy, some selective supply gluts, and on the other hand, we have mounting evidence of less oil production from mature fields, and obviously the whole fracking business is a financial disaster that's not sustainable either, and as a result, neither are those barrels that have been won and have added quite substantially to global supply. But oil, I think, is a good place to be strategically because it is a real asset, a very necessary asset, a vital asset for global trade, for production. Anything at all is going to depend on oil, and that is a great place to hide if you're having trouble with paper currencies or fiat currencies. Speaking of which, gold has also started to act well. It looks like it's in the beginning stages of a bull market. They're revisiting an old one after a long 6-7 year slide that took it down about 45%. Gold at $14.31 per troy ounce recently is up well beyond the 1360-ish level that a lot of chart technicians looked at as the top of its range that it couldn't pierce in any significant or lasting way. So it looks like we're off to the races in terms of resumption of the gold bull market in dollar terms. It's happened in other currencies, but has been hidden thanks to dollar strength. Same holds true for silver, which has been a laggard refused to join the gold dollar or the dollar valued gold bull run revisited, but silver at 1642 last Friday is rebounded sharply during the last week or two and looks to be joining the precious metals bulls party, albeit with a delay. And as a result, the silver to gold ratio is finally coming down. It got all the way into the mid 90s and it's now below 90 as silver has been increasing in price more rapidly than gold, which would also be a substantiation of a new precious metals bull market. Let me get into the topic at hand, the U.S. abandoning, in essence, any fiscal rectitude. White House and congressional negotiators reached an agreement on a 2-year budget on July 22nd, a week ago today, that would raise spending by $320 billion over existing caps and would allow the government to keep borrowing, generating yet more red ink on top of an already surging deficit that keeps pushing the federal government's towering $22 trillion debt load higher and higher. You know, the recklessness that having the global fiat reserve / settlement currency has bestowed upon U.S. power brokers since the dollar gold standard was terminated in 1971 is beyond words, and the damage as well. Meanwhile, we've got about 70% of federal spending falls into the non-discretionary or mandatory type of spending, which includes transfer payments such as Social Security, Medicare, Medicaid, veterans benefits, unemployment benefits, disability income, as well as interest on a national debt, right? And that spending, which constitutes about 70% of all federal government spending, is positioned to continue to outstrip nominal GDP growth on a secular basis, given the aging society, the huge baby boomer retirement wave of over my generation, of over 10,000 a day for the next 10 to 15 years in America alone, and the large unfunded public sector pension debacle. And all this, less than wonderful stuff, is prior to interest rates inevitably reverting beyond the average 4 to 5% yield that 10-year Treasuries have historically had on average over multiple centuries. In all, and as per the non-partisan CBO, the Congressional Budget Office, federal debt to GDP is set to soar. U.S. federal debt to GDP is set to soar way above its current 104% level, given the government's spendthrift trajectory and societal aging. And that 140% public sector debt to GDP is already a flashing debt red light, because countries, historically speaking, have tended to get into growth trouble and also political trouble when public sector debt exceeded 90% of GDP. At 104%, the U.S. has blown way past that. So, caveat emptor, Treasury purchasers. What happened to the Tea Party movement, which focused on getting government spending under control? I often ask myself, it's gone. How so? It's Trump's big spending Republicans. Is Republican Party, which has joined spendthrift Democrats to speed up America's financial demise, which will ultimately kill the buck with the buck's purchasing power, spike real-world inflation even much, much higher, and collapse Americans' borrowed living standards, that is, debt-based living standards. Boy, that Tea Party of 2010 or 2011, I think it is dead, gone. And the tragedy here in the making is being underwritten by none other than President Trump, who, as a candidate, promised to attack the bloated government and huge deficits under both the Bush Jr. and Obama administrations. What an unmitigated disaster, doubling down on unparalleled spending prolificacy and unrivaled debt. Sadly, and most destructively, there are no adults with a conscience in the U.S. government when it comes to fiscal matters. At least I can't hear any of their voices. Can you? Both parties, the Dems and the Republicans, are big government parties, eager to spend and redistribute out of an empty pocket money, funds to constituents that return them to power, from the non-maker masses to corporate welfare, also known as cronyism. All the while, federal bureaucrats remain busy forcing compliance that costs U.S. businesses over $2 trillion per annum. And especially since the trade war started to rise in meaning, we've got an over 2 million strong bureaucracy and a growing part of which is busy collecting ever more Chinese import tariffs paid by American consumers and U.S. businesses, Mr. Trump, not by China or Chinese. Meanwhile, America is over 72 trillion in debt at all levels, or 3.4 times U.S. GDP. All levels, American debt was up 3 trillion in 2018 alone, while nominal GDP rose by 1 trillion during 18, or a third as much as debt. Not a great return on yet more gigantic borrowing, which is precisely the rub. Speaking of 3 trillion, corporate debt since Q1 09, during the depths of the last S&P 500 crash, is also up almost 3 trillion, and near doubling, suggesting that the interest cost component of S&P 500 earnings per share is set to surge with any material return to higher corporate borrowing costs, further pressuring down cycle earnings per share already in the pipeline. And this doesn't even get into or address weak organic growth prospects, the result of majoring in stock buybacks and corporate anorexia instead of top-line growth for the better part of the decade. The interest rate sensitivity of the U.S. and also the global economy, with some 250 trillion in debt, could not be any more substantial or threatening, as I've detailed multiple times. Using the KISS, or Keep It Simple and Straightforward formula, if the benchmark 10-year Treasury yield went from 2 to just 5% and stayed there, this would roil financial markets and the real economy. Recall, if you will, that in August 1981, the 10-year Treasury's yield reached 15.4%. and the 30-year yield almost also exactly 15.4%. Yet back then, the U.S. had a much better balance sheet with only 31% public sector debt to GDP, that is federal debt to GDP, virtually balanced trade, and it was a nominal creditor status nation versus being some 10 trillion in debt, the 10 trillion plus debtor nation. My point, treasuries yielding 5% within a relatively short period of time, if not substantially more, seems like a pretty good bet to me. In such a world, America's interest bill, given widespread use of short-term financing, would rise by about roughly 2 trillion within a matter of years, which would be the equivalent of nearly 10% of today's GDP. Talk about growth headwind. And that headwind would be before additional multiple trillions in new debt were added to the nation's tattered balance sheet. Obviously, all of this is a status quo power broker non-starter. The elitist, bureaucratic, and plutocratic parasites that have been getting rich off a redistributionist, private property shredding, Main Street maker eviscerating economy on the one hand, and on the asset bubbles that the Fed and other central bankers around the world have blown with zero interest rate policies, negative interest rate policies, and counterfeit electronic currency on the other hand, surely don't want Frankenstein finance to stop on both sides of the aisle. Any party, all politicians. Because life is too good for the 1%, the de facto modern global communist party. And as such, all eyes are on stock and bond valuations in order to sustain the unsustainable for as long as possible. And perhaps I should refer to the 1% as the de facto modern fascist party, as communists own all the assets and fascists simply control them. Therefore, look for the Fed to cut its Fed funds rate in the upcoming week. Moreover, expect this to be an opening salvo, as signs of economic weakness mount to such a degree that not even the fake economic statistics proffered by the bureaucratic statisticians will be able to continue to put real GDP growth statistics out much longer. That is, positive real GDP growth statistics. And this is prior to an even more entrenched, increasingly global trade war. Thank you, Mr. Trump, which will clock both global and national economic growth. Remember that world trade is under substantial pressure. Remember that world trade constitutes 58% of global GDP, up from 36% 4 decades ago. As trade goes, so goes the global, the national, and ultimately the local economy. Therefore, look for the misguided or perhaps devious Keynesian Fed to continue to cut rates towards zero and possibly even beyond that as select Keynesian Swiss/European central bankers, central planners are letting it be known that they might have to take future aim at negative 4 to 5% interest rates, those they can control, to get reluctant consumers to spend. Think of savers losing 4 to 5% of their money that they have lent their governments each year for 10 years straight. This takes yield starvation to a new level of insanity, morphing it into an even more aggressive form of property transfer from savers to debtors. It makes zero interest gold and silver look downright appealing in comparison, doesn't it? And this is before precious metals' renowned strategic purchasing power maintenance track records are even considered. Moreover, precious metals have managed to retain purchasing power even if real inflation rates are used, not the fake ones we get from the government, which are about half as high as reality. Right, candidate Trump? Therefore, look for the Fed to revisit money printing / balance sheet expansion of one sort or another before all too long. I personally think it will happen prior to year's end. Then look for the other leading central banks, led by the ECB and the BOJ, to keep their currencies from rising against the dollar by expanding their already prolific currency debasement efforts, be they more NERP, negative interest rate policies, or more QE / balance sheet expansion. In short, look for enhanced and likely unprecedented global currency devaluation contests in the not too distant, if not in the near future, perhaps this year yet. Amidst all this gathering Frankenstein finance perversion, look for the malinvested, over-indebted, massive new debt dependent, savings starved, product portfolio uncompetitive U.S. economy, almost $1 trillion deficit in trade, in almost $1 trillion trade deficit in goods. Look for the product portfolio uncompetitive U.S. economy to head into a likely unprecedented recession. Q2's 2.1% real GDP growth is a debt-enabled, overstated real GDP growth rate that will likely look like heady growth in the near future. The impending economic weakness will also clock financially engineered versus organic growth-based S&P 500 EPS, as I've often addressed, both in posts and in videos. That 50% plus EPS compression, let me call it Finance 101 or P&L, Earnings Residual 101, will finally prick the U.S. stock market bubble, which is running on easy money fumes, about to get more abundant with an EPS abyss dead ahead because they haven't killed the business cycle. The upcoming reversion beyond the mean stock market correction, let's call it a crash, will inevitably be a double whammy. 50% plus lower EPS residuals and higher risk premiums / lower PEs. Thus, today's 23 PE of S&P 500 GAAP trailing 12-month EPS will face a 1-2 punch. And I believe it will face it in the near future, as in likely starting this year yet. EPS imploding by say 50% would push today's S&P 500 index valuation to a nosebleed 46 PE. The first punch, stocks fall by 50% to reflect the EPS implosion. The second punch, investors will ultimately demand a return to higher earnings yields, lower PEs, higher risk compensation, something which the upcoming bond bear market will only exacerbate. In other words, the S&P 500 could easily fall substantially more than 50% in the not too distant future within the next year or two. And please recall that it took 5 years for the 2006 S&P 500 EPS peak to again be barely surpassed. For those with interest, please see post 25. Moreover, back then, GAAP or real EPS that include restructuring costs of continuing operations, GAAP EPS back then plummeted from 06 to 08 by 86% over 2 years or in 2 years. And this was a much less indebted, less misallocated, higher productivity, more organic growth environment. Yet long-term S&P 500 EPS growth from peak to peak has only been about 3 to 4% per annum over more than a decade. Now, do you want to pay 23 times bubble/financial engineering earnings per share for that kind of weak EPS growth, which could well get weaker still, given the headwinds we face? In any event, a cratering U.S. stock market will no doubt put the Fed and the rest of the world's leading central banks into save the stock market's overdrive. In plain English, unparalleled counterfeit currency destruction thanks to a global effort to prop up stock markets, including the rest of the world's stock markets, even those that have already taken it on the chin. I don't believe for a second that the U.S. stock market, if it collapses, will leave other markets, even those that have already been under pressure, untouched. It's just too correlated. And that's how all the central bankers will pitch in the currency devaluation contests, a beggar thy neighbor version of saying. Sooner or later, creditors will also comprehend that the long-term funds they lent can't be repaid, at least not in today's purchasing power, nor remotely close over time. Upshot, bonds, the ultimate asset bubble some 4 decades old, will also enter into a long beyond the mean valuation reversion, which will have central banks printing with ever greater fury in an effort to neutralize bond vigilante sales. In other words, bond vigilantes demanding much higher risk compensation for either insolvency or inflation. And inflation, again, is nothing other than a piecemeal insolvency until it speeds up into hyperinflation. With record debt outstanding, central banks will have a tough time offsetting scared vigilante bondholders looking for the exit. In other words, it'll be a tall order, even for the leading central banks, especially once the confidence levy breaks, and especially given the huge indebtedness of the world, the large claims on output that the global bondholders have. Honestly, can you think of a more overall destructive stock and bond valuation scenario? Allow me a brief caveat. Attractively priced, vital, scarce resource stocks in the food, energy, and precious metals patches stand to do very well, in my opinion, even as the stock tide goes out. Stocks as an asset class get clobbered. But such stocks will prove the exception to the market cap drubbing that lies ahead. Suffice it to say that both stocks and bonds are tied at the discount rate hip. We also go into this in detail in post 25 and elsewhere. And both assets, bonds and stocks, are priced in counterfeit currencies, which will increasingly be printed into oblivion because politicians and central bankers alike can't afford to level with the public as regards unpayable Social Security, pension, and medical benefits, lest people vote them out of office or take to the streets against the very plutocrats and bureaucrats whom they will ultimately blame. So, the elite will continue to pursue an at first sneakier default, also known as inflation, or massive monetary base expansion in a fractional reserve banking system, which ultimately brings us Venezuela. That's the only politically viable course until it doesn't work anymore. Honestly, can you think of a more bullish scenario for physical gold and physical silver, both of which are historically very underrepresented, that is, underowned portfolio assets, with silver's upside potential between 3 and 6 times gold's revaluation performance to an estimated $10,000 plus level per troy ounce, just based on the current expansion in the global monetary base, the debt that it has spawned, and the traditional precious metals backing of currencies at between 20 and 40%. Money supply at between 20 and 40%, which will have to be revisited, precious metals backing, if confidence in currencies needs to be restored. But that would be icing on a private sector reallocation cake, or in between 200 trillion and 300 trillion in investable assets will look to collectively reach 1 to 2% precious metals exposure instead of today's between 0.5% and 1%. With precious metals so scarce, only a much higher equilibrium price will result in the sought after exposure to the only real safe havens, even as government bonds will become known for what they already are today: junk bonds without any yields. That emperor wears no clothes. And not only the 5-year-old boy is going to see it, the rest of the investors will too. I can't think of a more bullish secular scenario for precious metals, for safe cash, short-term government bonds, where the printing press can repay you and you don't have duration risk. And I say that notwithstanding the fact that the Fed's return into full-fledged financial repression will initially boost the stock market, the S&P 500, if you will, to even more insane valuation levels. That is, until earnings collapse. Remember, the stock market is no longer a good leading indicator thanks to central bank policies. Commensurately, the upcoming stock market lift from a reversion to permanently lower interest rates at the short end and to full-fledged broad daylight debt monetization at the long end should be seen as a late in the day opportunity to reduce capital at risk. Recall that the stock market's ability to discount weakness is not what it was in prior years before such massive financial intermediation by the world's central bank before their imaginations. So expect, just like in the last recession, for the stock market to be a lagging indicator, not a leading indicator, and fully expect, as news from the economy continues to show a progressively weaker economy, that if it isn't already a recession, is rapidly heading into one. And that, heaven knows, will cut EPS by 50% or more this time around, given the headwinds we face. I hope you've gotten something out of this in terms of food for portfolio allocation thought. I think the full-fledged broad daylight debt monetization that will likely soon be upon us is indeed an opportunity to reduce capital at risk in both stocks and bonds. I'm signing off here with, this is Dan Kurz, DK Analytics. It is July 29th, 2019. With one more video from the beautiful village of Niederweningen, Switzerland. Bye-bye.